In today's episode, I'll talk about two interesting stories. In the first one, I'll talk about how a cancelled satellite deal from 2005 has put India's global assets at risk of being seized by foreign investors. And in the second story of the day, I'll talk about how India quietly has become a global shrimp powerhouse and what two key companies reveal about this underwater export industry. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest and the most interesting pieces of news in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Tuesday, the 10th of June. Something very strange is happening with Indian government-owned properties around the world right now. From a swanky 35 crore rupee apartment in one of Paris's most exclusive neighborhoods to bank accounts and government buildings across the US, Indian assets are all of a sudden under threat of being seized by foreign investors. And at the heart of all of this lies a satellite deal that was signed nearly 20 years ago between a small Bangalore startup and a division of ISRO. And just last week, this particular case took a sharp and a bit of a worrying turn. See, the United States Supreme Court, which is one of the most powerful legal bodies in the world, unanimously ruled against a very key argument that the Indian government had been using to shield its overseas assets. And that particular deal has opened up a massive $1.3 billion enforcement action against India to move forward. The risk is diplomatic buildings, state-owned bank accounts, and public company assets that are held in America. All of them could be dragged into court and potentially seized. So to really understand what's going on over here, let's very quickly rewind back to 2005 to get a good understanding. See, at that time, India's space agency, which is ISRO, was doing pretty well. It had earned a reputation for launching satellites at costs that were far lower than what most other countries or companies could even manage. And to make the most of this momentum, ISRO's commercial arm, which is by the way called Antrix Corporation, started looking for ways to bring in more revenue. And that is when it met Devas Multimedia, which is a Bangalore-based startup founded by former ISRO scientists. Now, Devas had a very interesting idea. What if you could beam high-speed internet and multimedia content directly to mobile phones using satellites? Now, mind you, this was long before there was widespread 4G or even for that matter proper broadband connection in most Indian households. So basically, in some odd way, this was a version of what Elon Musk's Starlink is doing right now, but it was back in 2005. Now, the two sides shook hands at that point in time on an ambitious deal. Basically, Antrix would launch two satellites into space and they would lease 70 megahertz of precious S-band spectrum to Devas for 12 years. And in return for all of this, Devas would pay 167 crore rupees upfront and then use the spectrum to deliver digital content and services across the entire country. Now, of course, this particular idea was cutting edge at that point in time, and therefore it also attracted interest from global investors. Silicon Valley VCs, Deutsche Telekom, and funds that were based in Mauritius and the US all backed the idea. In fact, Antrix as well saw this as a very smart business opportunity because instead of satellites sitting half empty, they suddenly had a guaranteed commercial customer. But that said, there was one small catch. The S-band spectrum that Antrix was offering also had strategic importance. It was used by India's military and other sensitive communications. But at that time, both these sides seemed comfortable with all that risk. They moved forward, they built satellites, obtained licenses, and they got necessary international approvals as well. Everything was basically on track until it was not. In 2011, the Indian government abruptly cancelled the deal. The decision came from the highest levels, which is India's Cabinet Committee on Security. They claimed that they now needed S-band spectrum for national security purposes, and they ordered Antrix to terminate the contract completely. Now, what's interesting is that around the same time, the infamous Radia tapes had been leaked, which exposed political lobbying and irregularities around telecom spectrum allocation in India. Now, the government was under intense public pressure because of this, and pretty much anything that involved the word spectrum had suddenly become politically toxic. So, Antrix sent Devas a letter saying that the deal could not go forward due to a change in government policy. And along with that letter, they also sent a check for 58 crore rupees to return the amount that Devas had paid upfront. Now, in legal terms, Antrix argued that this was a force majeure situation, which means that something had happened that was outside their control, making the contract unworkable. But Devas did not buy that argument. They pointed out that Antrix itself was a government company and that it was the government's own decision to cancel the deal. They basically said that this could not even count as an unforeseeable event. Now, from Devas's perspective, the Indian state had completely changed its mind and it was now refusing to honor a simple contract. So therefore, they decided to fight this, and this is where things got global as well. See, since Devas had foreign investors and the contract had a clause for allowing international arbitration, the dispute very quickly moved beyond Indian courts. In 2015, an international arbitration panel ruled that Antrix had wrongfully terminated the deal, and they awarded Devas $562.5 million in damages with a hefty 18% annual interest. But that was not even the end. Investors from Mauritius and Germany who had backed Devas filed additional claims under India's bilateral investment treaties, or BITs. Now, for your context, these treaties are meant to protect foreign investors from unfair treatment. Now, between 2016 and 2020, more tribunals ruled in favor of Devas's investors, adding another 195 million pounds to India's liabilities. But India refused to pay over here. India disputed the very basis of these rulings and challenged them in court after court. In the meantime, though, the clock sort of kept ticking. That original $562.5 million award, thanks to compound interest, has now grown to around 1.3 billion US dollars. And if you add the BIT award to this, India is right now staring at a total bill of more than 1.5 billion US dollars. That, mind you, is nearly equal to India's entire annual budget for its space program. So the question then becomes, what do you really do if the government refuses to pay? The simple answer is you go after their stuff. See, after winning arbitration awards and court approvals, Devas' investors began a global hunt to seize Indian assets. They looked for anything the Indian government owned that was not protected by diplomatic immunity, which is buildings, bank accounts, or holdings of public companies. In Paris, for example, they found an apartment that was worth 3.8 million euros in the upscale 16th arrondissement, which was previously used by a senior Indian diplomat. A French court allowed them to place a judicial mortgage on it, essentially a legal claim over the property. And that is not all. In Canada, they managed to secure rights to a chunk of money owed to Air India via the International Air Transport Association, or IATA. And in the US, things got even more intense. A federal court in Seattle confirmed the 1.29 billion US dollar award, meaning that Indian assets in the US were suddenly a fair game. Investors even began scanning for attachable assets like PSU bank accounts, revenue flows, and anything and everything related to Indian public sector units. But that said, in 2023, a US appellate court complicated matters even further. They ruled that Antrix did not even have enough of a connection to the United States for American courts to claim jurisdiction. Now, the thing is, under the Foreign Sovereign Immunities Act, or the FSIA, foreign states are generally protected from being sued in US courts. But there is an exception for arbitration awards, and if a case involves enforcing one, you still can sue. Now, the Ninth Circuit agreed that the arbitration exception might apply, but they insisted that there must still be minimum contracts with the US. And this meant that Antrix's investors were completely stuck, but only until last week. On 5th June 2025, the US Supreme Court stepped in, and in a unanimous ruling, they struck down that particular logic. They said that FSIA already provides a clear legal path for suing foreign countries over arbitration matters, and that requiring minimum contracts would create unnecessary barriers. Now, the court did not decide everything. It just removed a key legal defense that India was particularly relying on. Now, the case goes back to a lower court where India can still argue on other points, but the door is now suddenly open for Devas' investors to pursue Indian assets in the US once again. But even this, mind you, is not the full story. See, while all of this was playing out abroad, the Indian government launched a parallel campaign at home to discredit the deal. In 2015, the CBI, or the Central Bureau of Investigation of India, filed a criminal case accusing Devas of securing the contract through fraud. And by 2016, the agency had filed charges against its executives as well. In 2021, Antrix went to India's company tribunal and argued that Devas was essentially a fraudulent company. Now, the tribunal agreed, and India's Supreme Court later endorsed this view, saying that if a deal is built on fraud, the entire deal falls apart. Now, that ruling gave India a new argument that if the original contract was fraudulent in the first place, then the arbitration award is pretty much meaningless. And based on this particular logic, the Delhi High Court invalidated the award in 2022, saying enforcing it would be equal to perpetuating a fraud. But this is where things get a little bit tricky, because while Indian courts have found Devas guilty of fraud, those findings have not been tested abroad. See, the thing is, none of Devas founders live in India, and without a full trial, it is not clear whether the charges will ever be proven proven in court. But still, global courts are right now treating this arbitration award as valid. So what we're left right now is a bit of a mess. On one side, India is being asked to pay over $1 billion by courts across the world, and on the other side, our own courts say that the company it's being asked to pay was built on fraud and never should have existed in the first place. And in the middle of all of this, India's global reputation is sort of taking a bit of a hit. And the reason I say this is because for many years now, India has pitched itself as a reliable, rules-based destination for foreign investment. But this Devas case makes it seem like the rules can change overnight, and that if you're a foreign investor, you might spend years chasing justice. And even worse, it shows how legal disputes can balloon out of control if they are not resolved early. So if you think about it, this whole saga sort of started with a contract worth 167 crore rupees. That was the original amount that Devas paid for satellite spectrum. But because the government backed out, fought every arbitration and let the interest pile up, that amount has now multiplied nearly 60 times. The question is, was Devas actually fraudulent? Maybe, maybe not. We still do not have final clarity. On that note, let's move on and talk about the second story. See, India is one of the biggest shrimp exporters in the world, but this is not a space that most people like you and I usually think about. You will not really hear about it on business channels, you don't see ads for it, and unless you're in the seafood trade business, you probably do not even know how big this industry is. But recently, two listed companies in this sector, which is Avanti Feeds and Apex Frozen Foods, declared their quarterly results, and the numbers show that this is a business that is definitely worth paying attention to. But before I talk about how these two companies did last quarter, let's start by understanding what shrimp farming even is and how did India become such a big player in it. See, when people like you and I usually hear the word farming, we usually would think about crops, cows, or something that is grown on land. But there is also farming that happens in water, and this is called aquaculture. Now, shrimp farming is a part of exactly that. In very simple terms, instead of catching shrimp from the sea, we grow them in ponds, and these ponds are usually near the coast, especially on the eastern side of India in states like Andhra Pradesh, and that is where most of the action is. Now, over time, shrimp farming has taken over shrimp fishing. What we usually called wild caught shrimp, which is the kind that is caught from the sea, now form just a very small tiny part of India's shrimp production. The vast majority actually comes from farms, and interestingly, we do not even eat most of it. Nearly all of it is actually imported to other countries. To give you a sense of the scale here, in the financial year of 2024, India exported seafood worth $7.3 billion, and out of that, frozen shrimp alone made up 2/3 or 67%. Now that makes it the single most valuable export item in the entire category of seafood. But the thing is, this was not always the case. India's shrimp industry is relatively very young. It really took off in the 1980s and the 1990s when farmers started growing a native species called black tiger shrimp. There was basically a lot of global demand, especially from countries like Japan and the US, and at one point it looked like India had sort of found a gold mine of sorts. But this early growth also came with some very big problems. Farms were set up without any rules, and many destroyed coastal mangroves. Some even polluted nearby lakes and rivers, and things got so bad that in 1996, the Supreme Court had to step in. Now, they passed a landmark judgment that banned shrimp farming in sensitive coastal areas. And mind you, that one particular case, which is also by the way known as the S. Jagannath versus Union of India case, brought the entire booming industry to a complete halt. Eventually though, the government set up a body called the Coastal Aquaculture Authority so that they could regulate shrimp farming. But just as regulation was improving here, the industry ran into one more major problem, which is a disease. See, in the early 2000s, farms across India were hit by a virus called white spot syndrome virus, or WSSV. Now, when it infected a pond, it could kill off all the shrimp in just a few days. Now, the losses here were absolutely massive. Many farmers quit the entire business altogether. Now, this of course was a very low point, but the breakthrough actually came in 2009 when India approved of the farming of a new species of shrimp, also known as white leg shrimp. Now, this species was not native to India, mind you. It came from Latin America, but it had a few big advantages. It could grow faster, it could be farmed in higher numbers, and most importantly, it came certified as disease-free. Now, that tag is called SPF, or specific pathogen free. Now, this, mind you, does not mean that the shrimp are genetically modified. It just means that they are bred in secure and sterile facilities, mostly in the US or Mexico, and they are tested repeatedly to make sure that they are free of any major diseases. Now, India started importing these adult shrimp, which are known as broodstock, and then using hatcheries to breed baby shrimp called post larvae for farming. And that one small change, which was switching from black tiger to this kind of shrimp, completely transformed this industry. The way the whole system works now is actually quite organized. It starts with broodstock, which, like I said, are adult shrimp that are imported, and they don't go into ponds directly. Instead, they are actually kept at hatcheries where they lay eggs. Now, these eggs hatch into larvae, and over a couple of weeks, they grow into post larvae, which are basically baby shrimp. Now, farmers buy these post larvae, stock them in their ponds, and feed them commercial shrimp feed, which is usually a mix of fish meal, soybean meal, and nutrients. Then over the next 90 to 120 days, the shrimp starts growing. And once they are large enough, say about 30 to 50 shrimp per kg, they are harvested and they are sent to processing plants. Now over there, they are cleaned, peeled, frozen, packed, and then exported. Thousands of small farmers across the coast are involved in this particular supply chain. And Andhra Pradesh alone accounts for around 60% of India's shrimp output. So now that we have a good understanding of how the entire business works and how it even came about to be, let's get into the economics of it. See, for farmers, the biggest cost is their feed. This accounts for around half of the total cost. Then comes power, which is for the aerators that keep the pond oxygenated, the cost of baby shrimp, labor, and water treatments. Now, how much profit a farmer can make here depends on three key things: how many shrimps survive, how efficiently the shrimp can convert feed into body mass, and the market price at the time of sale. Now, in a good season, margins can be strong, especially if the shrimp are large. But when global prices fall, profits can vanish quickly, like in any other business. In 2023, for instance, many farmers made just 5 to 6% margin or skipped farming altogether. Anyway, for processors, which are companies that buy shrimp from farmers, clean and package it, and export it, they run on high volumes and very, very thin margins, usually around 4 to 7% only. And that is the backdrop against which two companies, Avanti Feeds and Apex Frozen Foods, reported their Q4 FY25 earnings. Let me start with Avanti very quickly. See, Avanti Feeds is the largest shrimp feed manufacturer in India. It controls about half of the entire market. Now, most of the business is tied to how well India's shrimp farmers are doing, obviously. When the farmers do well, they buy more feed, and when disease, bad weather, or low market prices affect farming, Avanti's business obviously takes a big hit. Now, last quarter, Avanti had a mixed but a mostly positive showing. Its total revenue grew 8% year over year and reached about 1,385 crore rupees. But what really stood out here was the profit. They earned 157 crore rupees, which is up 40% from the same period last year. The reason was feed. See, while revenue from feed was only up slightly from 996 crore rupees to 1,035 crore rupees, the company saw a big jump in profitability. And this was largely thanks to lower input costs. Prices of key ingredients like fish meal and soybean meal dropped. Fish meal fell from 99 rupees per kg to 91 per kg, and soybean meal from 52 per kg to 43 per kg. Now, mind you, that is a big deal for a company where feed is the core product, and like I said, almost is 50% of the cost for farmers. But that said, one raw material, which is wheat flour, did get slightly more expensive because it is tied to government MSP prices. But overall speaking, the raw material basket was much cheaper. The company's processing business, though, saw a bit of a different story. Revenue here rose from 287 crore rupees to 350 crore rupees thanks to higher volumes and better pricing. But margins fell. Last year, this segment had an EBITDA margin of 13.7%, but this time it was just 7.6%. Why, you might be wondering? That is mainly because of tariffs and freight costs. See, shrimp exports to the US now face a 33.12% total duty, including anti-dumping, countervailing, and a new 10% tariff that India added in April 2025 in retaliation for America's trade policies. But despite all of this, Avanti acted very quickly. They pre-shipped large volumes before the tariff even kicked in. They also increased prices by 10% for US buyers, and many accepted it as well. And that helped them hold on to their sales, but they know that this will not work forever. So now they are diversifying, and they are trying to grow in Japan, Korea, Europe, and even the Middle East. They're also focusing on more value-added shrimp products, which is the kind that is peeled, cooked, or has a tail on, which basically fetch better prices and face lesser competition from cheaper exporters like Ecuador. Anyway, let's now move on to Apex Frozen Foods. Now, Apex is a vertically integrated company. That means they handle everything from hatcheries to farming and processing and even exports. Their operations are largely concentrated in Andhra Pradesh near key ports like Kakinda and Vizag. Now, Apex has also been pushing very hard into the RTE, or the ready-to-eat shrimp products business. Now, these of course have higher margins and are less exposed to global price swings. In FY 2025, RTE products made up 26% of their total volume, which is up from 15% just about 4 years ago. And that of course is a very big shift. Their biggest market though is still the US at about 53%, but the European Union is now very quickly catching up at around 39% revenue, up 26% last year. Now, talking about Q4 specifically, Apex made a very strong comeback. Their revenue grew 22% year over year to 197 crore rupees. But the real story was in the turnaround in profit. The company had a 4 crore rupee loss last year, and this year they posted a 2 crore rupee profit. EBITDA jumped 174% to 7.8 crore rupees. You might be wondering how? That is because they earned more per kilo of shrimp, which is 794 rupees per kg and is up 20% from last year. And at the very same time, the cost of raw shrimp also fell about 4% to 358 rupees per kg. So basically their margins expanded on both of these ends. Now a big part of their Q4 success also came from Europe. Now Europe shipments rose 70% year over year, and Apex believes that there is even more to come over here. One of their plants that makes ready-to-eat shrimp is still waiting for full EU approval, and once that clears, they also expect to add another 2,500 metric tons in volume from just that one facility, and that could be a bit of a game changer for their margins. The company also said that they have cleaned up old issues, which is bad debts, lost clients, and provisioning from previous years. They had lost ground to Ecuador and Vietnam, but they are now slowly winning back US clients and growing very quickly in Europe. So basically both Avanti and Apex are now betting on value-added exports and diversified markets so that they can survive the pressure from tariffs and price swings. And while global shrimp trade can be largely unpredictable, India's place in it is clearly not small by one bit. There is an entire ecosystem over here, which is something that started with coastal ponds and now feeds into global supermarkets. You just have to look closely to understand these insights. That brings us to the end of the two stories of the day. On that note, let's move on to the final section and talk about the quick news headlines. First, JK Cement Limited has acquired a 60% equity stake in Srinagar-based Safco Cements at a total consideration of 150 crore rupees. Safco, for your context, operates an integrated cement plant with a clinker capacity of 0.26 MNTPA and grinding capacity of 0.42 MNTPA. The company reported a turnover of 73.17 crore rupees in FY 2025, and as part of this deal, JK Cement will assume management control and nominate 3 out of 5 board directors. Second, the government has increased the onion cost recovery rate to 72% for the current Rabi season, up from 65% last year. Now, this means private contractors who are storing onions under the central buffer scheme must ensure that 72 kgs out of every 100 kgs remain marketable post-storage. Third and the final one for the day, Tata Steel is set to commence construction of its electric arc furnace project at Port Talbot in July 2025, aiming to begin operations by 2027. The project is backed by £500 million in funding from the UK government. That's all the news and stories I have for you today. I hope you enjoyed this episode. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.